Hello, Rick Komarek, Certified Financial Planner, and today I'm going to share with you an article that I just uploaded to my blog titled, Why Should You Diversify? And here's the context. For the past 5 years, ending in October 31, 2018, the S&P 500, which is the U.S. stock market, has an annualized return of 11.34%. Wow, that's very impressive. While the entire world index minus, that's ex-USA, returned 1.86, and the emerging market index returned 0.78. So obviously those are a lot more dismal compared to what the US has done over these past 5 years. US stocks have outperformed international and emerging markets over the last several years. Some investors might be reconsidering whether or not there's a benefit to investing outside the US. Well, there may be some benefits to doing so, and here they are. Non-US stocks help provide valuable diversification benefits. And also, recent performance is not a reliable indicator of what's going to happen in the future. So let's take a look at it. There's a world of opportunities out there in the equity or stock markets. The global equity market is large, and certainly the US does accompany the majority of that. Here they are, United States at 52%. So yes, most of the world capital markets are located here in the US. But at the same time, that leaves 48% of the opportunities are outside the US. So there is a significant amount of opportunities that are available outside of the US. And let's take a look at the lost decade. This was the period from 2000 to 2009. We had the dot-com crash during that time, as well as the credit crisis and such. And so that entire decade is termed a lost decade by US investors because essentially it was flat every year, a fraction of a percent, but for the 10-year period, it had a cumulative return of negative 0.9. Now let's contrast that with the markets outside of the US. That's what ex-USA means. And this market provided 17.47, 48.7, 94.3, 154.2, and 212.72 total cumulative return during the same time period. So there is a valuable benefit to having exposure to markets that are outside of the US. Now, is there a systematic way to pick which countries in advance which will outperform? Well, let's take a look at those countries. They're listed here on this, what I call patchwork quilt or scatter chart. And what you can see here is every year, all these different countries just kind of randomly give their returns. In other words, there's no real predictable pattern about which country will be the best year to year. Therefore, it's always a good idea to diversify amongst the different countries that are available. And that's why we take a diversified approach. Over long periods of time, investors may benefit from a consistent exposure in their portfolio to both the US and non-US equities. While both asset classes offer the potential to earn positive expected returns in the long run, they may perform quite differently over the shorter time periods. While performance of different countries and asset classes will vary over time, there's no reliable evidence that this performance can be predicted in advance. An approach to equity investing that uses the global opportunity set available to investors can provide diversification benefits, as well as it may provide some higher expected returns as well. If you have any questions about diversification, your investments, retirement, taxes, insurance, anything financially related, feel free to contact me anytime.